Welcome to the latest edition of Fundamentals. This week I'm going to be looking at one of the passive funds on our list of favourite funds, the iShares Global Government Bond ETF. It's an exchange-traded fund, or ETF, and is designed to track the performance of the underlying assets and deliver that performance minus its running costs. In this case, the ETF is tracking the Citigroup G7 index. This is a benchmark that's made up of bonds that have been issued by the governments of the G7 group of nations. So that's Canada, France, Germany, Italy, Japan, America, and the UK. The tracker uses physical replication to provide performance. What this means is that it's buying the actual underlying bonds. And so if you buy this tracker, you get immediate exposure to its entire portfolio of 696 different bond holdings. The portfolio is so diversified that the 10 biggest positions represent just 4% of the £718 million under management. The largest individual shareholdings are all US government bonds, which are also known as treasuries, and by geography the USA is the biggest exposure. As we can see here, US treasuries represent 43% of the portfolio, with Japanese government bonds coming in at nearly 24% and France at 10%. All of the bonds in the portfolio are rated as investment grade by the big rating agencies, so Standard & Poor's, Moody's and Fitch. That means all of the bonds are rated as BBB and above, and implies that the chance of any borrower defaulting or not paying the coupons or interest on these bonds is pretty slim. The vast majority of the bonds also have at least 1 year to their maturity, which is when the governments have to repay the principal or original loan. The next chart shows the overall maturity profile of the assets held by the tracker. This next chart shows the average coupon range of the bonds. Since we're dealing with bonds which offer, in theory, a very low chance of default, the risks are quite low, so the interest on offer is in turn relatively low. So the overall yield on the tracker fund is around 1.1%, and you'll receive a dividend on it twice a year, in January and in July. The fund comes with a 3-star ranking from Morningstar. As a final point, iShares Global Government Bond ETF is eligible for SIPs, ISAs and dealing accounts, and the minimum investment is just 1 share, which at the moment is around £83. So why would an investor consider this ETF for their portfolio? The first option is portfolio diversification. Lots of investors are drawn to stock markets in their search for yield, but bonds are an alternative asset class to consider. The second reason is that stock markets are currently wobbling a little amid fears over Turkey, trade wars, tariffs and whether global growth is capable of living up to current expectations. After a near 10-year bull run, some analysts are arguing that we're overdue a bit of a stumble, and that could favour bonds, or at least means having a more diversified portfolio might be wise. Remember that bond prices fall as yields rise and vice versa, and for the moment bond yields have failed to rise to the level that many had been expecting. The one to keep an eye on is the benchmark US Treasury yield. If that goes above 3%, then the theory is that bonds could sell off hard. But for the moment, that doesn't seem to want to. This shows the US 10-year Treasury yield over the past 2 decades, and why moving above 3% could break a long downtrend. Finally, remember that bond prices tend to fall as interest rates rise, and rise as interest rates fall. Intriguingly, the experts at Capital Economics are now predicting that the US Federal Reserve will start to cut interest rates again in 2020 as America's growth starts to slow down. If that view's right, and that's a big if, then bonds could do relatively well, assuming that inflation stays at lower levels. However, iShares Global Government Bond ETF may not be suitable for all investors. It's worth considering these points. Firstly, that 1.1% annual yield may not be enough for everyone, especially income seekers. That yield doesn't even cover the UK's current inflation rate of 2.5% based on the Consumer Prices Index. And if global growth does pick up, then bonds could struggle, especially ones that come with a low coupon. Second, it's possible to argue that bond yields are artificially low and bond prices therefore artificially high, thanks to central banks' use of quantitative easing or QE programs. This is where they create fresh electronic money and use it to buy bonds to depress yields and make it cheaper for governments and companies to borrow. That sounds good, but the tricky bit now is that the US Federal Reserve is starting to withdraw QE, the Bank of England stopped adding to it, and the European Central Bank is about to stop adding to its scheme. This removes big bond buyers from the picture. This chart shows the performance of the tracker relative to the year-on-year increase in new bond buying by 5 major central banks. Of course, you must do your own research to ensure that the iShares Global Government Bond ETF fits your own personal overall investment strategy, your target returns, time horizon, and appetite for risk before you're thinking of putting any capital at risk. Thank you for watching, and I look forward to seeing you next time.